Welcome, everybody. Another Ask Me Anything happy hour with the crew. We've got the Brady Bunch in effect, and we are going to go live with your questions. And we're going to answer your questions. We're going to do what we can. You might not like the answer, but you know what? It'll be the truth. And sometimes the truth hurts. So get your questions ready. We'll be right back after this. All right, we are back at it. Another Ask Me Anything happy hour, and I mean anything. You can ask anything. You might not get the answer you want, but shoot it out there. So with that being said, let's go around the block here, starting with
Steven.
He's looking at you, Snaggy.
Hey, what's up, everyone? How's everyone doing today? I hope you had a nice Memorial Day weekend. And it's been busy here. We had a good show of webinars today. If you caught the wealth webinar with Mr. Chris Rude, talking about affordable housing and how impactful mobile homes can be, especially for investors right now. It's a hot market and something there's a lot of money to be made. So check that out on the recording on the YouTube channel at the Chris Noggle on Saturday. When that recording is put up, I had a good show on what the F happened this morning, just talking about all the craziness going on in the world and in the news and with the markets and everything that's always happening. And it's been a good day today, though. It's been a good week, getting back in the swing of things, and talked to a couple clients, some different questions coming in around, what they think they should be doing and stuff like that. So looking forward to answering some questions today and having a good time. So I'll pass it over to Mr. Brian Fouts.
What's up, everybody? So Jason, you might like to know I had my MRI finally in my shoulder yesterday. That was an extremely unfortunate and not pleasant experience. Really painful, but had to sit in that machine for about half an hour. But yeah, so we'll hopefully get some good results on that. But had a lot of repeat clients here recently in the last week and a half. So a lot of other policies being done, second policies, third policies on juveniles and kids. So I love seeing that, and that people are getting such a good experience out of infinite banking. They want to start doing more of these and pass it down the generation. So that's a really cool thing to be seen. So love that. And with that, I'll pass it down to someone we haven't seen in a while, Mr. Carson.
What's up, everybody? Welcome. Thanks for being here on Ask Me Anything. This is Carson Herlean coming to you guys from Southern California. I have been out the past 2 or 3 weeks, traveling at different events, different countries even, and seeing some fun stuff. So this last weekend, just an update for you guys who know that my wife is pregnant. We had a little baby shower this weekend. Baby boy coming in like 2 months now. It's coming really fast, so we're getting excited. And so that was a fun weekend, and now we're home. No travels. We got to stay home for the next couple of months and enjoy this time before we have a baby. So it's going to be a good couple of months. But besides that, we're doing great. So
very cool, Carson. We're excited for you, man. Very excited. So I'll do a quick introduction for Ethan on the team. So Ethan's part of the I team. So those of you that put policies in force, as you may know, our implementation team is there to help you implement the infinite banking concept into your lives and help you plan out those loans and how to manage your policy and move the money properly. So Ethan, appreciate that. And I know you're part of the National Guard and sometimes away on different events going on with that, but it's glad to have you back, part of the I team. And with that, I wanted to play your introduction song. So this is like if you're walking up the stage to introduce yourself. We're jamming, baby, just because of your background. So
I like
it. Introduce yourself. You got to talk over the music.
Hello, everybody. This is Ethan Evans here again from the I team. So like Steven said, glad to be here and answering your questions. And I had a couple of great conversations with brand new clients today that were, their policy just went in force. They're getting ready to take that first loan. And I love helping to kind of make that light bulb come on a second time for clients, and showing by paying off your debts how much money we're able to help you recapture, and showing that within this guy was less than 12 months, he was able to go from a a premium of this much to more than doubling that once we factored in how much money he'd be recapturing, and talking about how he could use that to open up a second policy for himself, on his wife, or somebody else in his family. So I love to kind of helping to make that go full circle and showing you guys how to really put this thing to work. So that's all for me. Glad to answer your question. So over to my friend Craig.
All righty. And Stephen, I thought you did such an awesome job introducing Ethan. I'm going to let you do introduction to me too. So I'm just going to kind of hang back.
Well, I'm not prepared for that, man. Right, So wait for next week. I got you, dude.
All right. Next week.
Dire Straits. Come on, Snaggy. You could have just went with the guitars and did some Dire Straits, Money for Nothing kind of.
Oh, I actually like that. Money for Nothing. Yeah. Craig Yenny here, just south part of the Denver area. And we did have a good wealth webinar. I don't know if anyone was on it, but we had about 250 some. But some of those mobile homes are so sweet. I'm looking at those thinking, man, that's not the mobile homes that I was thinking about. But yeah,
I'm thinking about selling my house.
Yeah. I mean, I've been watching this show every once in a while when I get a few minutes to sit on the couch, which is usually like between 8:55 and 9 o'clock before I fall asleep. But there's this show where they build container homes, like little tiny container homes. Those things are so cool. But anyway,
they're neat.
I just love that affordable housing. I think it definitely fills a need in the industry. So anyway, that was a really good webinar today.
All right, Craig, I'm ready for you. Hang on. Before we move on from Craig, you guys got to know who Craig really, truly is. So, Craig, this one's for you, my friend.
You asked for it, Craig.
Something heavenly led me to you.
Oh,
Look at the sky.
all right, Mr. Craig. Yeah,
Thank you. I was actually hoping for some music, but that's good. Down to you, Jason.
I don't know if I can follow that up, man. 2 intros like that. So down here in the city, beautiful. Got out for an early morning ride today. Went around Lake Apopka. It's actually the first day of summer, kind of. Connor's done with elementary school, going to middle school. And the reason I'm sharing the ride around Lake Apopka, some other rider this week got his bike attacked by a gator. I don't know the full story yet, but that's kind of freaky. I'm glad I didn't know it till I was halfway through my ride, seeing gators out there. So,
awesome.
Well, everybody get those questions in. Where's that? No, Shauna today. I noticed.
Yeah, Shauna was
just
down in
noticed.
Orlando planning out our November 7th and 8th Private Money Club Money Tank event, which is going to be amazing. It's going to be at Universal Studios property, and already looking forward to that. So get it on your schedules, November 7th and 8th. With that said, you and me, Brian, are on question asking duty today.
There we go. There's the first one. They're from Anna. And she's asking, if you don't qualify for a policy, how do they calculate what you can put in for a child policy?
Does she have really long arms?
Fisheye lens.
So I guess what she's asking is, if you get denied for a policy and then you want to do it on a child, what are the limitations on the child policy? So obviously juvenile versus an adult child, that varies right there. But anybody want to answer it if it's a juvenile, what they would look at?
certainly, they would look at the amount of coverage on either the mom or the dad, and you could go up to half their coverage, up to $1 million, whatever the death benefit is on their body.
Well, I think they said if they don't qualify. Yeah.
Well, then it would be on the spouse, hopefully had insurance, right? And then you would go from there and engineer it that way. And if that isn't the case, then you're going to be limited. Go ahead.
I was just going to ask. Actually, I actually don't know if they don't have any
household income, if I'm not mistaken.
No, they're limited. We've seen Fouts, you know the answer to this. I know you do, because we've had this conversation a couple times when, depending on the carrier, they're going to be limited up to a certain amount of coverage if the parent can't have the coverage.
Yeah, because I think I got a response one time. I don't know if it applies to this situation, but it was a $100,000 death benefit. It wasn't very much. It was very small.
I was thinking 250 max, so somewhere between that 100 and 250 is what I was thinking.
Maybe.
So I don't know if that's accurate. We'd have to
Yeah, similar
verify.
case, and I had that 250 number in my mind as well, because I just had a situation where the parents didn't have insurance and they couldn't get insurance, but the grandmother wanted to do a policy on the granddaughter, and I think they were able to go up to 250. But I think a lot of that's going to depend on the underwriters and situations, family, income and assets and things of that nature.
Yeah. AI says 100 to 500.
It depends on the carrier, is what I remember was the answer. And then if it's a grandparent policy, which is that's actually, I have Lafayette's stuff right in front of me. That's $100,000 without any coverage qualifications for the parents. So a grandparent can get a policy on a juvenile grandkid for up to $100,000, and I've done that many times. Now, if the child is over the age of 17, so they're 18 or older, then the amount of death benefit is going to be based upon that person's income and age and that kind of qualifications. So it depends on the age of the child. So, cool. What's this one? Mindpure says, any credit sponsors who JV to close on MF?
Credit sponsors who JV to close on a multifamily. Not quite sure what they mean by credit sponsors.
Yeah, I'm not sure either. I mean, I know there's...
I think you need to go to privatemoneyclub.com, build some relationships on there with some other investors and private lenders. So that would probably be the best advice anyone could give you. And I think that would be a good starting place. But just brush up on definitions of credit sponsor, because I don't even know what you mean by that.
I mean, I think like a credit card or something like that, or a line of credit when I hear that, but I'm not sure. I don't know.
So Shahiba up here on Instagram seems to keep saying, you didn't reply. Chris, are you going to reply to me? I said, you didn't ask a question. So how about start with the question and then we'll reply to you, because you're not going to get a fire without putting the logs in.
There we go. All right. So Mr. Justin's asking a good question here. So if you have a premium of, say, $10K annually and you're getting close to paying that annual payment and don't have the liquidity, can you reduce it? Is there some wiggle room to a certain extent or no? So I'm assuming he's saying he's coming up on the annual premium due date. So what is his options if he doesn't have the liquidity?
All kinds of options.
Lots of options, yeah.
Drop it to quarterly, drop it to monthly.
Keep going, Joe.
I said a couple. Somebody else can say a couple.
Got a couple.
The big one is we can reduce the paid up addition rider free as well. So if say if you had 8,000 or 9,000, you could put in that much. We could just reduce down. We'd have to look at your illustration and see how your policy and see how it was illustrated and designed. But yeah, we can always dial back that paid up addition rider. Typically $120 a year or $10 a month is enough to keep the PUA rider alive and happy. And then you're still moving the policy forward, no penalties. And then when you're back on your feet or that extra cash comes in, you can go and get back up. You make your normal payments and make some catch-up payments typically if there's room.
There you go.
Good job.
Yep. Okay, so Anna follow-up to this one says 13 and 15-year-olds, so they are under the age of 18, and both have one policy for $250K New York Life basic policy.
Yeah.
So,
I think the most they'd probably be able to get under those circumstances would be another 250, and that would be probably redlining it.
Yeah. So, I mean, I know if you have the parent has a lot of coverage, you can get more coverage on the juvenile.
Sure.
You'd have to have quite a bit more. Like Lafayette, I think is 100% up to $500K. So if you have $500K of death benefit, you can get $250K additional on both of them. If you have $2 million, up to $2 million, it's 50% of that they can get each one. Yeah. So that's what it says right here.
Yeah, I have a client that did 50,000 premium deposit in for each of his children. We had a tough time getting this one issued, but I mean, it bought millions of dollars, like millions and millions and millions of dollars worth of coverage on his kids.
With that, Chris, I mean, that's impressive. That had to be like a big estate planning, right?
Yeah, I can't remember. It definitely had a cover letter. There was lots of back and forth. Underwriter or somebody on the team had to call the owner, which was the father, just kind of see it. But it was estate planning and just lots of future planning for them.
I got 25 on Ariana.
There we go.
And they didn't ask you anything, right? They just gave her. Those were back in the good days.
It's me.
Yeah, exactly. I mean, you got to be like Joe.
There you go. All right. Kevin's asking a question here. How much do you charge every month to supply?
Uh-oh. Brian froze.
Guess I'm up.
You're up.
Yeah, coach, I'm ready. All right.
It sounds like they're asking if the money multiplier charges our clients a fee for having a policy, and if that's the question, the answer would be no.
We only work on tips because tips are soon to not be taxed.
There we go. Tips are gladly accepted.
Yeah, I mean, Kevin, so there's no direct charge. We don't charge anything to work with you and provide the service and training and create the proper policy and solve your problem at the end of the day. That's all we're doing. But the way that this works is the policy is built on a whole life insurance policy. And so the way whole life insurance works is we're licensed agents to be able to provide these policies. We contract with insurance carriers. Insurance carriers provide those policies, and we're paid just like any other insurance agent through insurance commissions. So whether you went direct to the insurance carrier or come through us, it's the exact same policy. There's no extra fees to work with us or anything of that nature. And so being tax deductible, typically it's so the only money going out is your premium that you're paying, whether that's monthly or annually or whatever your premium might be. And that premium typically is not tax deductible in most cases.
And I'll say this, there is one group out there, at least I know two, but one that I know personally. They charge a $5,000 fee to do infinite banking.
Yeah, I know two companies, and I'm sure there's more, that are charging thousands of dollars just to kind of teach you about the infinite banking concept. And then you pay them that, and that's what gets you the ability to get a policy designed by them.
Mm-hmm.
Yeah.
We just do it all for free.
And then there's an ongoing charge too.
Correct. Yeah. There's
be part of their group. And then the one I know of, they're providing opportunities to put your policy into. So investment opportunities, which is real estate. So the client, they're not the client, but the company is actually making money multiple ways because they're a real estate, they're licensed real estate people. They're actually buying the properties and selling them at a for profit to you at a raised price. They're making money 3 or 4 different ways that I'm aware of. And so
you wait till the FTC finds out about them, and I know exactly what you're talking about. I won't mention their name, but yeah.
Yep.
But what we do is we just do it all for free. We give you all the education for free I have
Come on, that's too good to be true.
Yeah, Jason's got 7, I don't know how many videos you have, 70, 80 videos or so.
No, I'm well over 100 plus, brother.
He's over 100 plus videos. He's got a really cool one I just started watching today. So collaboratively, we have thousands of videos that we've done completely for free. We do 6 webinars every single week, completely for free. And we charge nothing to set your policy up. We just get paid the commission like Steven. But if you want, we will send you a link, and it has one of those things. You just pick which tip you want to leave. I'm sure you all love that. You go to 7-Eleven to buy a bubble gum, and it asks you to tip, and you have to literally hit extra buttons just to not tip.
Chris, I want to know if that works for you. I say that on a bunch of calls, and no one sent me any money yet.
I've never tried it.
Tips.
Yeah, tips. We work on tips. I think what you got to do, Jason, is you mail them your tip jar. You mail that to them, and you ask them for a tip, and then you put a return envelope or a return postage paid envelope, and then they send your tip jar back.
It's like those chain letters back in the day.
Yeah, you remember them?
Yeah. Oh, that was great.
You go broke doing that in today's world.
Oh, geez. Let's see. Navigate your ventures. Do your policies show the maximum you can put in after the 10th year, or typically the base premium? If just the base premium, then can you typically put in what is reflected on the 8th through 10th year as PUA?
Going to depend on Shane. It's a great question. It's going to depend on the carrier. One carrier will let you put 3 times that basing. So I know you have policies with a few carriers, and the other ones you'll just have to check depending on how they're structured, what the riders are that are in there for it, right? If you can put additional PUAs in. So
yeah. And what you can also do is also just ask your agent to show you an illustration with maximum funding. just as long as you can fund it, maximum funding. And actually, I've been providing those more often now to clients, saying, hey, here's the option of dropping it off, but here's the option of not dropping off. Here's what it looked like. It's up to you what you do, but here's the options. But we typically show it dropping off after year 10. Yeah.
And as you're operating, so Shane, as you're operating, you can get an in-force illustration every year and just run that maximum from that point forward. Those numbers will change over time. So if, say you're in year 3, you run an in-force illustration, that may be different than what you saw in year 2. So it's always dependent upon how those dividends are paid, the MEC calculations, but I just run an in-force illustration with max funding to see what it can do.
Okay, so here's his follow-up to that one. His question based upon in-force illustration shows 24K annual through year 7, just under 24K for years 8 through 10, and then 6K years 11 through graduation. So yeah, so the term rider's dropping off at year 8. So that's why it drops down there most likely.
Mhm.
And then your PUAs are dropping off after year 11. But what you're asking is, can you keep putting in additional PUAs beyond year 10? Possibly.
Depends on
You just
the
have to
term
have
rider.
those run the show.
It would depend on a lot of things. Probably not, because the term rider is probably an 8. It's either an 8 or 10 year, or sorry, a 7 or a 10 year term rider. So it's probably dropping off. Or I suppose you could. Ethan, do you know? Can you keep, like, if there's a 10-year term rider, are you allowed to keep it on after that, and then does it just continually just keep getting more and more expensive, like an annual renewable?
I believe it would, because it doesn't, we always say drop off, but it's still going to be an action where you'll have to tell the insurance company, I want to drop the term rider at this time. And we check the MEC at the time to make sure we're still safe to do so. I usually tell people, yes, you usually can put a little bit more in, but to your point, Chris, it's based off of, what's the total amount of life insurance base plus the term, and is there still that wiggle room? So I just look at it as like, it's just like checking the MEC limit every year of like, how much extra can I put in? And that's my top off of that I'm going to aim for.
Yeah.
Because he's saying he can put in an additional 916 extra PUA annually.
And Shane, when we met, right? Shane wasn't Shane that he is now. Like, he's grown so much.
Mm-hmm.
So when we met, he was in debt, and so everything was going towards the PUAs, with very little going to the base, which is why there's only a little bit of PUA being able to go back in now for that particular one.
And one of the other things you could do, Shane, is, and I did this on one of my policies years ago. I just went back in and asked for a policy modification where I added, I think I had a 7-year term. I might have put a 15-year term on. By doing that, you're leaving that room in there where you can continue to put more PUA. And then if you did a dump in initially, a lot of times you can ask, depending on what company it is, if it starts with an L, this is one of them you can do, where if you had a dump in initially and you have that room in the term, you can go back and ask for the approval to continue that dump in years 2, 3, 4, 5, 6, 7. If you have a 15-year term, you can keep doing that for 15 years. So sometimes a policy modification will get you what you want with just adding more term, if that's the direction you want to go.
It's company specific too, correct? I mean, One America, you could probably put the PUAs in a lot longer than.
Well, see, One America doesn't start with an L.
There we go.
Details.
Good one. All right, let's see what else. So Anna had a follow-up here. If my husband can qualify, would my income help with the premiums to be put in if I don't qualify? Yes. So if you don't qualify, then they look at household income in most cases. So yes, it would add to the total amount that you would qualify for. Good question. All right.
God bless.
Yeah. So Jared asks the question, if your premium deposit is due on the 20th, do you need to wait until the 20th to have the money pulled out, or can you request it to pull earlier?
You're saying paying premiums on the 20th and then requesting the cash value loan the same day? Is that a question?
I think he's asking
He's talking about
can you
having
pay
the
the premium
premium
earlier?
withdrawn from his bank account to go bank account up to the policy to pay the premium.
I mean,
I'm
most
pretty
cases
sure
you would wait.
I actually paid a month early, and they didn't take it out until the date.
Yeah. The only other way to put it in that, what's that account that you can put it in that pays your premiums?
The premium deposit.
Premium
fund.
deposit fund at Lafayette.
You could put it there, but it doesn't add to your policy earlier on. It's just,
It's just like
that is a weird thing. They're just bizarre. The insurance companies just don't want you to pay early. Like, people ask all the time, and the insurance companies pretty much take the stance that you can't pay early. It's probably just because their systems don't account for that. And just so you know, insurance companies, as you probably are aware, are very old. I mean, companies are sometimes 160 plus years old. So some of their systems are just old, and they're updating them. I know all the insurance companies that we work with are spending tens of millions, if not more, updating systems, processes, computers, and software. But yeah, it very well could just be a component of they just don't have the technology to do it yet.
Yeah.
Here's a question I get quite a bit, and I'll put it out to the group. So, can you change the date of your premium, like on the day of the month? Can you change that?
A little bit, yeah. There's usually a little wiggle room where, like, if your anniversary date was on like the 5th, you can shift it like up to so many days. I'd have to check carrier by carrier. But I've had clients ask me that where, they know when their paychecks come in, then they want their premium to be taken out after their normal paycheck cycle. So you can fudge it a little bit. There's just a range where they don't want it, too late, where it's kind of like bleeding into the next month or something.
One of the strategies I had a client do, they wanted to have base premium taken out on that regular monthly. And so they didn't have any PUA coming out, and then they just manually put in the PUA later in the month whenever they wanted to. Some months they could put in 250, some months they could go to 300, but it was sized to where they would just fill out their PUA based on what they could do that month. So they could have a regular base payment coming out on that 20th, let's say, for example, and then 4 days later, put some PUA in.
There you go. Cool. This is a good one. Is there a YouTube link to the 90-minute video presentation?
It's funny.
Yes,
you should ask.
there's lots of them.
You should ask, put that up there.
Yeah. So there's lots of them. Take Back Control Tuesday. You can go to Chris Noggle YouTube channel and look up Take Back Control Tuesday. You'll see that 90-minute presentation, many different versions of it there as well. So, let's see. Kevin's asked another question here. What are some of the reasons why you won't recommend a policy to someone? Ooh, that's a great question. Because I've denied people policies.
Let's go around the room.
I'll tell you right now. I had one today, actually. I feel so bad, though, because they're so eager to learn and try and save. I just know it's not quite ready for them or right for them yet. But this lady was 38. She only income she had was from the government to pay for her social or her special needs child, and she was a full-time caretaker for her son. And she brought in $3,000 a month from the government, and that was it. And she had saved no money, not a dime, and she was just trying to find a way to start saving and growing her wealth. And I feel bad because it's like you should start a policy. This would be a great way to get you to start saving, building up an account. But if you're negative or broken even every month and you have no other way of producing income, it's very hard for you to do something like this. And I feel scared, honestly, because you probably will stop paying premiums because you won't be able to after a certain amount of time. And that's not good for you or for me or the insurance company. So situations like that are common. And the tough answer is, hey, you got to find a way to make more money.
Yeah.
Hard for some people to hear, but it's usually what most people need to hear. So that or spend less, that works too, but that's usually harder to do than make more, in my opinion. So that was the situation I had today, where I told them to kind of hold off a second.
Yeah, the other common one I get is that if you're, let's say, 50 years old and we do the math and your gross income is too low to qualify for the minimum premium for infinite banking, so you can't even qualify for $500 per month, which is 10 times your age. If your income is not high enough, you can't even qualify for the premium on the policy. So that's another one.
So both those examples are the first business is what? The business of making money. So that's the first thing. Then the second business is the business of banking. So, another one would be if someone comes in and they're really, you can hear it in their voice and their mindset and their words, what they're talking about as just being, hey, I want this and they feel like that's going to be the solution, but they haven't started paying themselves. They're not saving. Like maybe they're a good earner, but they're not saving anything. They just think this is another product that if they start doing this, it's going to solve all their problems.
Yeah.
But they haven't created the one habit of paying themselves first on a consistent, persistent basis. That's another reason I won't move someone forward. is if they're not, if they can go and pay themselves for a few months and then come back. So it's or on the other side, it's the people who come in and they've been burned and they've been in a bad relationship. They've lost money or something else. And they come in and they're very skeptical. This is too good to be true. If this was true, everyone would do this. And you can hear it in their voice that they just don't believe. It's like Henry Ford said, you either think you can or you think you can. Either way, you're going to be right.
Yeah, that's a mindset. The mindset's a big one right there. Well, I might say, hey, you need to go do some more research first. Here's some information. Here's some resources. You got to get that mindset one, first. But the other one is also financial responsibility. And I had a client who was making $150,000. I mean, a lot of income coming in, and they were actually borrowing from Peter to pay Paul with debt every month because they had such bad financial habits. And I had to be very blunt with this individual, but they were paying. It was $1,900 a month for 2 car payments, and one of the cars wasn't even theirs. And I asked this person, I said, well, what's the car for? To get to work, it was 10 minutes away. I go, what's your payment? It's $1,000 per month on this car payment. And the car was an $80,000 car. And I said, you're underwater right now and you're borrowing from your pension to pay your bills, which is digging a hole. I said, you got to get rid of the shovel. I said, if I were you, this is not financial advice, but if I was in that situation, I would sell the cars. Because if you sold those cars and got just a normal car, she would be breaking even and actually being able to save a bit of money. But she hadn't even thought about that. This person hadn't even thought about that first off. And she thought the policy, like Jason, you said, was going to solve all the problems. So I was like, nope, this is going to dig the hole deeper. Said, you don't even have the cash to do this. So that person had some very bad financial habits. So that's a big one right there.
I'd go ahead and add to this one. I've had cases where it wouldn't be, I won't recommend it, but I say not now. And so as we're going through, let's just take someone who has some debts. We go through their debts, we get them organized, we figure out what's the best way to pay the debts down. And a lot of times it'll be, you do have some cash flow that could be put into the policy, but we need to clear out some of those debts. So maybe after you get rid of the first 3 credit cards, you now have $300-400 of cash flow with some extra cash flow. Maybe we can make this work. So it's sometimes we have to get some of those debts out of the way to get some cash flow in order to do the program. But the other thing we can talk about is if you're interested, there's term insurance that's convertible. And let's just say a year from now, you're not insurable due to some, health issue. So if we lock in that insurance and that insurability today with a term policy, maybe in a year, maybe in 6 months, maybe in 9 months, you can convert that to whole life if you have insurability issues. So sometimes it's just kind of looking at where are you now? We put a plan together that you're going to have to do most of the work because you have to go clear out these debts. You have to build some cash flow. And then if you want to lock in your insurability, we can help you with that piece too.
Yeah. Great.
I've got a variation off of what these 2 guys just said about both income and debts. One variation I'll see where, if your monthly cash flow, if you're either just barely breaking even or even negative because you've got too much debts, yes, you got to clear up the debt situation first, as Craig said. And one thing I've recommended a couple of times is like, look, if you may not qualify, or it might not be a good idea to start with the whole life policy yet. Go and learn about velocity banking, whether at Christy Vann's channel or anywhere else, and start, and then, put your attention and focus on that, to use that as a tool to really understand the time value of money, start getting yourself out of debt. And then again, come back when you're in a better spot, and we can take some of that freed up cash flow and then use that savings to then start the policy.
Yeah, there you go.
Here, I got a question just to kind of go off of this one for you guys. So I talked to someone today, and they were retired. They're really unfortunate where they put their money, from a self-directed and over $1 million into some equity deal that went south. And then they took out a second lien HELOC on their home and took all the 200,000 plus of the home at like almost 11% and put it into crypto.
Oh.
And then they had they're flipping tractors, which is super cool. Like they're making over 200 grand flipping tractors a year in retirement. So super cool. So they wanted to start the policy, then have that go into the HELOC and then pay off the mortgage. And I was like, no, you need to make more money with the tractors, put it into the HELOC to get the interest down because they're paying a bunch in the interest. then build that up over time, and then pay off the home with that if you want to, or learn something else that you can know, like, and understand. And once you start having positive cash flow from that, because they're basically going, like Joe, they're going one step forward, one step and a quarter back, one step forward and one step back. So, I mean, that was something where IBC is just not the play yet, right? Because A, they're not making enough money, and two, they'd be creating multiple debts when they don't need to.
Yeah.
Is that how you guys would have thought through that as well? Does that make sense what I said?
Yeah, for sure.
Yeah, I mean, cash flow is, cash flow's king right there. Makes sense.
I mean, the difference was, like, if they're on the what they put in crypto, the $238 a month was like almost $2,400. So if they had $50K sitting there in a checking account, if they put that into the HELOC, that would drop that payment by $500 a month immediately. Right. So
cool. So Navigate had the comment here. So he just, his second policy has more PUAs, wrapping his head around future policies and design. So cool.
The coolest thing about your policy, Shane, is that you're using them, you're banking, and they were perfect at the time they were created for where you were in that moment. Now that your thinking has been rethought, you will continue to evolve and have different designs based on what you really want in the future.
Yep. Yeah. Double black hole. Yep, for sure. All right. So Fern has a question here. So if we're taking a loan from our policy to pay the premium, well, that's interesting right there. Do I need to pull it out and put it in my segregated account and pay from there? I have a One America account. So I'm assuming you're saying taking a loan from your policy to pay your policy premium. That's what it sounds like. The question I would be asking is, why are you doing that?
Because that's where she would be storing her money to pay her premium.
Yeah. So effectively, you're stealing from your bank to put money back in your bank.
Should she just leave it in a savings account, or should she put it back into her policy? That's how I'm reading it.
She's borrowing from the policy to pay the premium.
This sounds like you're having some financial troubles and don't have the new money or the savings to pay the premium. So I'm reading this as we're talking contingency plans here. How do we keep the policy going?
Yep.
And yes, then you could look at doing a premium loan for a short time to do that. And I think then you would just want to call One American and tell them, hey, rather than taking the loan and pay it back, can you just directly do it inside of the policy? But hopefully we're talking contingency plans here, not kind of course of action one.
I don't think it is. I think it's just a contingency. I think it's just like a temporary fix. And typically they would call that an APL, an automatic premium loan. So like if you didn't pay your premium, then and you have APL selected, which not all policies do. So don't play that game. The policy would just automatically take a loan to keep itself alive, to preserve itself. So I think that's kind of what you're talking about. I think just for the general, because we're talking to the public here and we got a lot of people that are listening to this, this should be a very, very consolidated strategy that you only use in absolutely dire periods of time where like you've exhausted all of the resources, you've reduced, PUA down, you've taken the mode to monthly so that it reduces it, and you're still kind of just trying to get it, where it needs to be or something going on in your life. Just don't make that a habit of doing that, because eventually that is like one of the only ways I have ever seen a whole life policy lapse itself. Literally, instead of the client lapsing it by not paying premiums, like the policy just ate itself alive, and it was from doing APLs. So just be very cautious about that.
I guess I'm reading this the wrong way. What happens if I had $100,000 policy a year, and every month I took $10,000 and put it into my policy, and then just to save up for my premium in 12 months? I guess I'm reading it wrong.
Yeah.
You see what I'm saying? If I had
maybe we just need the question reframed, because there is several ways you could hear this. So, Ethan's way of explaining it is kind of that last ditch effort, just keep the policy alive. And that might be the case.
If I had a $60,000 a year policy, let's say, and every month I paid back $5,000 to my policy, so I knew that I had $60,000 in my policy that I could pay the premium with. Why would I? I'm just thinking, why would I keep it in a savings account or in a segregated account when I could put it back into my policy and not pay interest on it.
Well, yeah,
I was talking like
I
a
see what you're
glossy
saying, Joe,
bank
but there's a
inside
lot
with
of things
with your
outside
owner
of it.
payments.
That's how I
That's
can.
assuming that the policy is being used for something else that's generating revenue that then goes back to pay the premiums, goes back, and you store it there. I get that, but from her other previous comments in these calls, I'm not thinking that's the case.
I'm reading this kind of like what Ethan said. It's kind of I don't have the money to pay my premium. What can I do? And I was kind of thinking back to when I took the Nelson Nash training. Policy loans were originally created for this purpose.
Correct. Yep. Well, we got an
Yeah.
Instagram comment coming in from I don't know you, 67, saying, how can you read something the wrong way? Read the question, and you probably read it the wrong way. Any more questions?
Perhaps they should read it to me.
Yeah, or maybe I don't know you should just read it to Joe, so then we don't read the question wrong. You read it wrong.
That's right. Call
But
me
maybe
up.
there's no way of reading it right because we just need more clarification about what's being asked in the question.
Yes. Call me.
Now
I
I'm just being an
hear it correctly.
Well, that's fun.
This
It's
belongs
fun.
on WTF. Sorry, wrong show.
Yeah, no, it's fun and fascinating, Crystal, because every single one of us hear every question slightly different from a slightly different frame, and we all have different answers. Even if they're similar, they're not the same.
Well, what it comes from is we're trying to figure out what the root of the issue is, and the root of the issue could be a couple different things, and so we're trying to answer the question based on our experiences of why people ask those types of things.
Mm-hmm.
So
there you go.
Craig, do you remember from the Nelson Nash stuff? Do you remember the year that policy loan started?
Was it
1852? I don't know.
Close.
It's probably earlier than that.
1830s.
1848.
No,
Yeah.
Oh, I was muted. I kept saying 1848.
Sure.
I needed that.
Quicker, I got to be quicker with you and you.
Well, let me ask you this: do you know how many licks it takes to get to the center of a Tootsie Pop?
Whoa, Mr. Freaking Sheets.
One, two,
One bite.
One bite. That's what I was thinking, Brian.
Yeah. Here's my hammer. There you go. This is an interesting one. So Hope, she made this comment based upon our previous conversation. She said she had a young girl wanting to rent a room, decided she couldn't afford it because she had to pay a $650 per month truck payment and $300 insurance. So that's right there. That's a mindset issue because that's what we're taught to do. That's what we're taught to do to live our lives, which is use debt and to have all these flashy things. But then we can't afford a basic room to live in. Priorities right there to me are just backwards on that. And that's, by the way, that is one of the things right there that destroys wealth.
Or if it's a long bed, I mean, she could throw a mattress in it and sleep.
Good point. A lot of people are dealing with this right now. If we've been covering this a lot in the YouTube videos. If you look at delinquencies on car loans right now, they're through the roof. And a lot of times, what happens is people during good times, they overextend themselves. They buy the car they want, and usually it's a brand new vehicle. And then all of a sudden they're stuck in this monthly payment. The easiest thing for all of us to say is we'll sell the truck or sell the car, but the car isn't worth enough to pay off the loan. Most people with car loans are upside down right now in terms of what is owed and what they could sell the vehicle for, because I know this is going to sound absolutely crazy. And this is just my theory. During COVID, believe it or not, people literally thought that charade with cars was going to continue going on. Like, I'm going to buy a car and I'm going to be able to sell the car for more than what I bought it for. I can't even count how many times I have heard people mention that. Oh, I thought I was going to be able to sell the car for what I paid for it or for more than what I paid for it. I'm like, wait a second. What are you talking about? Well, the prior car or whatever, I sold and I made money on the car. People literally thought that was never going to stop. It's just nothing. And now insurance is one of the biggest, I think, piles of shit going on right now. The insurance companies, I don't know what they're doing. I have a lot of friends in that industry and they're even baffled that it's a major issue right now and it's not going to stop. Like, the insurance company is literally overcharging people for premiums, just keep going up and up and up. I almost think they're just trying to see where the breaking point is.
You're talking about auto insurance.
I'm talking auto insurance, homeowners insurance, health insurance. I mean, where do I stop? Not life insurance. Life insurance.
Yeah, that's
Right.
what that's
I
the
don't think the
clarity. I
price
think
of
people
life
need to
insurance
hear.
has gone up ever. It's pretty much the death benefit costs
You're
with the death
talking
benefit
if
costs.
then insurance. If then insurance. If something happens, then it'll cover. If then insurance.
Yeah.
And look at this. Like Kay Blasted just said up on Instagram, average new car loan payment is $760. So one would argue that $650 monthly payment, that's cheap. Let that sink in for some of us that are a little bit older.
Okay. See here, Kevin.
Yeah, that's crazy.
Kevin's comment that those make sense. I'm currently debt free, but I'm working on growing my monthly income to budget a policy myself. So yeah, that's what we're talking about right there.
Does anyone else have a favorite line that people say to them when they're in their calls? Like that's my favorite when people go to me. That makes sense. And they say it multiple times, and by the end, I'm like, oh, I'm glad I'm making sense. That makes me feel good.
Or they say that you just stop talking.
My favorite one is this. And when I ask you, so do you have any questions? No questions. But can you clarify this for me? When I do this, what's that mean? I'm like, that's a question.
It's a clarifying question, though.
Yeah.
Different.
It's a different kind of question.
Hold on. I got to go back. How can you read something the wrong way? Well, because it was a clarifying question, not a question. That's why.
There we go.
Had to.
That's fun. Kukab. So it says, can I start a policy with 20,000 and maybe a 30K line of credit to start a 50K WLP and after 30 days take it out to invest it?
Theoretically, yes. Do I like it? No.
I mean, it's the same idea as getting a HELOC and dumping it into a policy. So, I mean, if you have a place to go make the money work for you higher than the line of credit interest rate and you feel confident in it, theoretically, yeah, you could do it.
Just got to measure the risk very carefully.
I mean, what you probably would do in that scenario, you could have a combination of a premium that is smaller and a dump in that makes up the 50. So you have more cash value to borrow early on to get into some other vehicle that cash flows. That would probably be a better structure. That way you don't have that 50K annually, which you'd have to qualify for anyways. But you just have to run the numbers. But it has to make sense to you. That's the thing. So you're asking a question right here that it doesn't make sense to you yet. So it has to make sense to you before you do anything. It can make sense to us all day long, but it's you that it has to make sense to first.
The breakdown of that is using leverage to create arbitrage.
Mm-hmm.
That's the breakdown right there.
That is.
And if the numbers make sense mathematically, that's what the equation would be.
And let me just add one disclaimer to what Joe just said. Make sure you assess the risk along with that arbitrage.
Yeah, because when you put the word invest in there, just understand that you're actually saying risk. You got to understand that investment means there's risk involved in some way, shape, or form in most cases.
I mean, literally, we're almost at a point right now. I was kind of hoping we were going to get there, but unfortunately, we're not. Where you could literally create a risk-free arbitrage, and we've been there a couple times close, where the yield on a treasury bond almost could support the cost of the funds from the loan. So you were almost at this pure arbitrage world. We're not there now, but how cool would that be if you could hit that? It would be for a temporary period of time, but if you locked it in, you could potentially get there. I mean, like, let's just say loan interest rates, hypothetical world. This is not where we're at today, but loan interest rates got down to 5%. But you could go out and get a 5-year CD for 5.5%. So for 5 years, you got a guaranteed arbitrage. You could do the same thing with a treasury bond, a little bit more risk added to it from a pricing standpoint, but the yield, like you can lock in the yield.
Yeah.
That's a cool thought.
Remember me and Craig did a video. What was that 2 years ago, Craig, where we did that?
Yeah, I think it was on one of the 3 days. We might have done that.
And it was working then, but it was just a different set of rules, for where we were at.
Yeah, we had
Ralphie
from the Christmas Story was part of that. Remember?
Oh, yes, I do. That was fun. That was really, like, we try to come up with cutting edge stuff that's like really on the brink, and that was probably, to me, one of the most cutting edge things we've ever come up with. It was literally, it was like for a limited time only, and boy, was that for a limited time only.
So Jared just paid his car off with his policy and no more payment to the bank.
Woo!
Very
You know, how good does that feel? I mean, like, come on. How good does that feel, Jared? Isn't it just freaking awesome? You're still making the monthly payment. And this is where some people get hung up on this. So like, but you're still paying $800 a month. Yeah, but I'm paying it to myself.
That was
I'm
gonna be my
keeping
clarifying question.
100% of it.
That was gonna be the clarifying question. Is that happening? Is that $800 a month?
We have
that
to
we're going
assume
out?
that he's been watching our stuff.
it coming
and he's
back? Is it
recycling and
coming back?
recapturing the money. Come on, give him some credit.
$9,600 a year. That's pretty solid.
That is solid.
This is an interesting one from Jay. Auto insurance without an agent. What is your take on it? Is it legit? I'm not sure
Like
what you mean
Geico?
by.
You mean like buying it from Geico?
I mean, you go to
You're not an
Geico and you
agent
just do it
with
online.
Geico,
There's no
is there?
agent. They are the agent.
Well, they're salespeople.
But like I used to have State Farm. Well, I do have State Farm, I guess, right now. But I have an agent that is my person I call. I don't call State Farm direct. I call the agent. Doesn't really matter. I've had Geico. I've had Progressive. Those ones, there's no one person I'm calling, so it's legit. I've had coverage to them, and I've actually had to use it before for an accident or a motorcycle, and I had no problem with it. So I mean, it's legit. I mean, what?
Yeah.
Geico's been around for how long?
Been around a long time. I mean, yeah, Jay. I mean, there's a ton of those online ones. What's that one with? Is it Shaq that's in them all now?
General.
What is it? General. The General.
General.
Yeah.
That I guess that's definitely an online only thing, and I mean that's legit. I mean, come on, Shaq's in it. It's got to be legit, right?
That's a great story to why he does that too. They were the only company that would cover him, and so then he came back and became their spokesperson.
You know the cool thing about
Weird.
Shaq, I'll give him some credit. Like everything he does has a definitive story behind it.
Yeah.
Like, you know, why he allowed, was it Walmart to make his shoes instead of taking that deal with Reebok? I think
Yeah.
it was Walmart, right? Like
Yeah.
each one of his things he does has a story. And same thing with the General. They're the only ones that would insure him. Like, how freaking cool is that? That's firsthand. That's like all of us, you know, we're out there teaching IBC because we're all using it and it changed our life. And it's the same thing for him.
So he really likes pepperoni too, then.
Well, I'm not saying everything he does is for that. I mean, some of it is just he just probably wants some more money, but at least he's got a story. My kids were breaking me. I needed to make some more money.
Yeah. So actually, he responded back to Jay. Got 4 separate brokers, including Costco, and ended up with the same policy. Talking about probably car insurance, something like that.
I don't know that world that well, but I'm sure it's probably just a smoke and mirrors.
I didn't know that Costco did insurance. That's news to me. I'm interested.
I got a question. Who on here has not yet gotten a copy of this book? Let's change that today. This is the companion. Hannah and I's first children's book. Shameless plug. Got to do it from time to time. The book is just so meaningful. I just read it to my daughter the other day, and I wrote the book, but you know, I sometimes forget the meaning and the way that it comes off. So folks, whether you have kids or grandkids or not, grab a copy of the companion by going to companionbook.com. That's companionbook.com or Amazon, and grab a copy of the companion.
Fantastic book. It's a fantastic book. It's one that you will not only get something out as an adult. It's meaningful if you're a parent. It's definitely something you want to read your kids, have them read it. It's a meaningful book.
I just
Very
got
well done.
Vivi's school to pick up a whole bunch of copies for their library.
And I was not paid to say that. I actually really enjoy it. Actually, well done.
Yeah. You can't find my copy right now. It's somewhere around here.
Yeah, mine's over there on the shelf. I was looking to pick it up to show it, but it's over there. So
Awesome. Thanks, everybody.
Okay, so Navigate said I got 2 after the call WTF this morning, one for me and one for my nephew and niece.
Wow, thank you. You know, sometimes like I just drop, like I'll just like seed it in things, and then I'll go and I'll look and I'm like, oh my God, it actually worked. People grabbed a copy of it. So I'm always very thankful for that. Very grateful.
Cool. Well, that's all the questions I think we have.
wow.
Any on Instagram or any of those platforms?
You did good.
Instagram, there's been a lot of people chiming in, but no real questions. I mean, just a couple comments. You know, Kay Blasted's been on since this morning, been having some really good comments and feedback. Everyone call your public, and I love it. Kay Blasted, always paying attention, man. It says, Everyone, call your public and private school library to get a copy. And sometimes that's all it takes is a recommendation for a library to pick up a book. And they will. I mean, they typically just get a couple copies.
That's cool. That's a good idea. Yeah.
Yep, it's available on now. It took us forever, but it is now available on Barnes & Noble. I got to get over to the local Barnes & Noble here and do a book signing.
Kevin has a pretty good question.
Shoot.
Third from the bottom.
Oh.
Can an employer offer any sort of whole life insurance policy for the employers where they can contribute to your policy or premiums?
Yes, the answer is yes. We used to do this all the time. When I was an advisor, I would go out to different companies. Instead of setting up a 401k, which can be costly and safe harbor rules, we would set up non-discriminatory benefit plans. We call them SLRPs. And I don't know how compliant that was to call them that, but that's what we call them. And we would basically set up whole life policies for all of the employees, and they were owned by the employees. And then the employer would say, okay, I'm going to fund, these for this class of employee. Everything was classed out. And that's the nice thing about doing it this way is you can remember that one movie, you're cool, fuck you, you're cool, like my language. I'm allowed to swear. I'm from New York. Everybody knows I have a license, Joe. We have a license to swear here.
Yes, we do.
But I'm just saying, like that's kind of what you can do. You could be like, all right, you're cool. I don't like you. Your division sucks. You got to get your ass to work more, and get on time. You're cool. And you could do that. And that's what these employers would do is they would pick an amount they want to fund for that particular class. We'd set the policies up. The employee could set up, how much they wanted to put in. And then the employer would put in we wouldn't call it a match, but their discretionary bonus is what we called it. And they would fund it. It was, what were they called? There's like some type of bonus plan. I think it was actually a discretionary bonus arrangement that we would set up with the company. And that's what the insurance company wanted it to be called. Really, really, really cool way to do it and to motivate your key employees where you don't have to give it to everybody like you would with a retirement plan where it's all or none. With this, just pick and choose who you want to motivate.
Yeah.
Great question.
Kathleen says, what can we do for you? You're also generous with your time. Thank you for all you do.
Keep showing up.
Yep.
Bring a friend. Bring a friend.
Keep sharing the links and share the concept.
Spread the word. Sometimes that's all you have to do.
Jay, we will help. We will definitely help if you'd like.
And Jay's actually my client, but so Jay's by the one that we're doing more than one carrier with for coverage potentially. But Jay, I think you may be pausing the process right now, so I know we're going to be talking here shortly. So. Yeah.
Thank you, Lucy.
Yep.
All right. Well, we are at time. So thank you all for your questions. It was just another really awesome show. Actually, we'll hit Steve's one last time. Do you guys like the economy now? Whoa. What do you guys think of the economy right now, huh? How about that economy? Woohoo!
I like helping people build their personal economies to be ready for this stuff. So yeah.
I didn't notice anything different.
Great your own economy.
Joe, when's the last time you left your house?
It's been a while.
Oh boy. Well, more to come on the economy, but let's just say my YouTube video is about spell out my entire take on where the economy is and where it's going. And I don't know.
Well, I think one thing we can offer with the economy is we have some tariff-free solutions.
That's true. That's true. Absolutely.
Craig, way to keep that in your pocket. Bring it back out.
Yep.
There we go.
Well done.
All right. Yes, Lucy's right. That would take another hour. So we're going to call it on that. Thanks all for joining us for Ask Me Anything Happy Hour. And thank you for the team for being here, having some fun with it, and letting me get at least my 1 or 2 swear words in for my quota for the day. With that being said, we'll see you all soon.